Time-weighted and money-weighted returns focuses on two major methods used to evaluate investment portfolio performance: the money-weighted rate of return, MWRR, and the time-weighted rate of return, TWRR. These methods help analysts and investors assess how effectively capital has grown over time under different circumstances. The topic emphasizes that portfolio evaluation is a critical aspect of investment management because investors and managers often face varying cash inflows and outflows during the investment period. Understanding the differences between these return measures allows financial professionals to evaluate portfolio performance more accurately and determine whether investment results were influenced by manager skill or investor timing decisions. The money-weighted rate of return applies the concept of the internal rate of return, IRR, to investment portfolios. It measures the discount rate that equates the present value of cash inflows and outflows associated with an investment account. Under this method, all deposits into the portfolio are treated as cash inflows, while withdrawals and ending portfolio value are considered outflows. Because the MWRR accounts for the size and timing of cash flows, larger investments during periods of strong or weak performance significantly influence the overall return. As a result, money-weighted return closely reflects the actual return earned by the investor rather than the portfolio manager's pure investment skill. The topic demonstrates how money-weighted return calculations are performed using financial calculators and IRR functions. In the example provided, an investor purchases stock, receives dividends, contributes additional capital, and later sells the investment. By entering the corresponding cash flows into the calculator, the IRR is determined as the money-weighted return. The topic explains that the sign convention for cash flows is important. Contributions and withdrawals must be entered with opposite signs. This methodology captures the investor's personal investment experience because it incorporates the effects of both portfolio performance and the timing of capital contributions. Consequently, MWRR is highly relevant for private equity, real estate, and portfolios where investors control cash flows. In contrast, the time-weighted rate of return measures the compound growth rate of one unit of currency invested over a specified horizon, independent of external cash flows. The process involves dividing the evaluation period into subperiods based on the timing of deposits and withdrawals, calculating the holding period return for each subperiod, and geometrically linking these returns together. Because this method eliminates the influence of investor-directed cash flows, it isolates the manager's investment performance. The topic emphasizes that TWRR is the preferred performance measure in the investment management industry because portfolio managers generally do not control when investors add or withdraw funds from their accounts. The topic also highlights the differences between the results generated by money-weighted and time-weighted returns. When investors add funds immediately before periods of poor performance, the money-weighted return becomes lower than the time-weighted return because more capital is exposed to unfavorable returns. Conversely, if contributions occur before strong performance periods, the money-weighted return exceeds the time-weighted return. This distinction illustrates how investor timing decisions affect MWRR but not TWRR. The time-weighted method therefore provides a more objective measure of portfolio manager skill, while the money-weighted method better captures the investor's actual realized experience and cash flow decisions. Overall, topic establishes the importance of selecting the appropriate return measure based on the evaluation objective. Time-weighted return is most suitable for assessing professional investment managers because it neutralizes the impact of external cash flows and focuses solely on investment selection ability. Money-weighted return is more appropriate when the manager controls capital flows or when evaluating the investor's realized performance. The topic reinforces the broader CFA principle that return measurement must align with the investment context and analytical purpose. Mastery of these concepts enables candidates to interpret portfolio performance accurately and apply the appropriate methodology in practical investment management situations.